All right, good evening, and thank you for joining us tonight. Our webinar is How to Underwrite Multifamily Deals. I'm Gary Lipsky, President of Break of Day Capital. Our other host is Kyle Mitchell, Managing Partner of Limitless Estates. Our companies work together and focus on acquiring multifamily real estate investments that offer value-add opportunities. We look in growing markets for under-managed assets to maximize investor returns. Our goal each month is to bring you a ton of free content in these webinars. If there's something you'd love for us to present on, please let us know. Next month's webinar takes place on Monday, September 23rd at 6 p.m. Pacific. Kyle and I will be taking you through a 42-unit multifamily deal that we own in Tucson. We'll go over the highs and the lows of our journey, as well as what's gone well and what hasn't. You won't want to miss it. Without further ado, let's jump in. Our guest tonight is Yusufov with Bullpen. Bullpen is the place to hire talented commercial real estate freelancers. Kyle and I have used Bullpen to help us take our deal analyzer to another level. Renat, please tell us a little bit about yourself and Bullpen.
Hi, thank you for the introduction. Just making sure everyone can hear me. Is that correct?
Yep.
Great. Again, thank you for the introduction. A little bit about Bullpen and myself. Bullpen is a marketplace where you can hire a commercial real estate freelancer for your business. Freelancers are experienced in underwriting, asset management, investor relations, and various aspects of real estate, consulting, and otherwise. So we launched our online marketplace actually earlier in the month. And we have been growing ever since, so definitely reach out if you have a need. About myself, I am a partner here at Bullpen. As mentioned, I came on board late in 2018, and we've been building the product since. My background is generally in private equity and development in real estate. I myself am based out of New York. Did my MBA here in New York as well in Columbia, and my undergrad in George Washington. So again, thank you for the introduction. Definitely look forward to the conversation. I will, sorry?
Oh, thank you for that.
Yep. Let me know if you're ready for me to take over.
Yeah, so we're gonna, if you guys have questions, please put them in the Q&A and we'll typically answer them at the end. And let's jump right in, Renat.
Great. Well, excited to do it. I will share my screen now. What I have for our presentations today, as we discussed, we're obviously going to go over the various intricacies of acquisition and underwriting of a multifamily product. Obviously, there's various risk profiles that we can get into. The product I'm going to be sharing specifically is a value-add model of a base case, just so we have a visual in front of us that we can discuss and play with the various financial toggles and engineering that goes into a deal. One moment. So please let me know if you can see my screen. I'm showing that I am sharing right now. If not, let me know. So as mentioned, we just want to have a visual in front of us as we go over the various nuances of the business, of the market, etc. What we have here is what you would typically receive in an offering memorandum from a broker or an intermediary, or perhaps even a seller directly. Usually it comes with these documents listed here. Rent roll, some form of an operating pro forma, be it in a trailing 12, a year to date, or it's for trailing 3 months. Usually you might even get all three. You can obviously ask for them. Both the rent roll and the operating pro forma usually come in Yardi form. As some of you know, there's some manipulation that goes into it in terms of formatting it for Excel uses. You could usually request real estate tax data. It's sometimes provided within the OM. Also, with a lot of cases, you can definitely look up the parcel, the offering memorandum itself, and a lot of good intermediaries will provide a comparable data, both for rent and sale, just so they can give you guidance on where they're expecting you to shake out on price. Also help anchor you, to be frank, to anchor you in terms of what opportunities are possible with the property that they're providing. Amenity lists become very important. Unfortunately, in some cases are glossed over, but it becomes very important in what we're going to be discussing here as a value add property, because tenants obviously care a lot about those things, and sometimes people just don't realize that it's a qualitative assessment that needs to go into the underwriting. local market data and local demographic data. Same story here as amenities. Usually these are key factors. You'll usually find them at the end of the OM. Very important, and the common case currently discussed in the country is Amazon in Virginia. A lot of people got into the multifamily game in Virginia, various aspects of Arlington, Crystal City, et cetera, years ago before this conversation came up, with the assumption of Washington, D.C. being involved in a lot of industries, so naturally a lot of big companies will end up moving to Arlington. Nobody, frankly, expected something like an Amazon to move in there, but those are the key winners of understanding what's happening in the local market, just as an anecdote. So scrolling through this, what you will usually see, you'll see the property pictures, obviously. You will have a general understanding of the interior, as well as a summary of what the current rents are. You will, obviously, in addition to the rent roll, get a perspective such as this one, a picture where they will lay out what the kind of units that they have, bedroom sizes, percentage of the total GLA, as well as the size of the units and the current market rents for each of those units, as well as per foot. Something to mention anecdotally, a lot of the smaller units will have higher per foot rent. So a lot of developers and acquirers will actually focus on apartments with smaller units. However, something to consider here is leasing costs are generally pretty standard, whether you're leasing a studio or a 1-bedroom or 2-bedroom. A and B, you also have to really understand the demographics in your area. If you're looking at an area that has a lot of small families moving in or new families moving in, obviously studios are not the product for them. Of course, vice versa as well. If this is a young professional area or an area that is attracting a lot of post-college talent, obviously 1 and 2 bedrooms are going to be very tough to lease. Moving further, obviously a little more data about the current occupancy. And then because this is a value add component, you will have at least the intermediaries or the seller's point of view on the meat that is left on the bone. They will outline generally what some of the unit improvements are still able, or what unit improvements you can engage in, and approximately what rent per unit you are able to increase from engaging in these improvements. Something to heavily caveat, of course, a lot of viewers here today know, this is one person's opinion or one team's opinion. It's information that has to be heavily vetted. You have to check it from multiple sources, including both the property manager or any expert on property management, as well as any GC that would be potentially installing these kinds of improvements. A granite countertop doesn't always translate to the certain rent increase that you might want. In some cases, and we'll get into it, improvements in countertops, improvements in appliances won't translate to any rent increases potentially, again, depending on the demographics that are in the property. You will have a general outline. This is obviously a garden style acquisition, but you will have general outline of units as well, and obviously more pictures of the property. So that is generally what you will see in OM. We've obviously selected a few pictures, trying to keep disclosure, secrecy, et cetera. We will get into the general model, the way it looks. The way the model is outlined, as you will see, is generally by individual box. And that way we can have an individual discussion about various aspects that go into understanding and strategizing around an acquisition. The way I like to do my models, people have different opinions on this. I prefer to do everything on one dashboard that is involved in the engineering of the aspect and engineering of the business plan. That way you don't have to jump around to see the effect that it has on your returns and your pro forma. We will get into each individual item. First, I'll give you kind of the layout of how the model works. As you can see, there are certain items that I've highlighted in bold boxes. These items tend to be the most important aspects of your underwriting, and we'll obviously get into every single one of them, including thereafter, as we discussed, rent premium from improvements, acquisition price, spread on your financing, spread on any supplemental financing, and of course, exit cap rate. We'll come back to this page in a bit. Just want to show you the remaining tabs are generally data that wouldn't be disputed when you're trying to underwrite a model. You can obviously, try to squeeze a little more dollars in the sense of your CapEx, et cetera. However, these are generally items that you wouldn't be able to engineer as part of the business plan, right? Lights cost what lights cost, carpeting costs what carpeting costs, unfortunately. We'll start with the unit mix. I have some notes here, so feel free to read them as I'm speaking, and definitely ask questions if you have any about this subject. As laid out in the OM, you'll be able to see the various units. One thing that is important to differentiate is the market rents that are provided. These are obviously rents of a similar unit in the specific market versus the current rents that you'll be able to find in the rent roll. This will give you a pretty good idea as you're beginning your underwriting and you're plugging in your numbers to see how underleased this property currently is before any of the improvements are done. You can see that potentially there's some juice you can actually squeeze out from either improving the leasing strategy, or if you have any other angle, or maybe it just needs more time to find the right tenant. Something to consider, as mentioned before, obviously smaller units will generally see higher rents per foot, but obviously leasing costs are pretty fixed. Know your customer, so to speak, as you would in any other business. Understand the kind of user of the product that you're looking to attract here. Again, smaller families probably are looking for 1 or 2 bedrooms at this point. Individual, young professionals are looking for a student, they'll be comfortable with that. Mind you there as well, because this is a value add property that we're discussing. People who are generally seeking a studio are people who are generally looking for a place to sleep, and therefore they are not as keen on paying necessarily $80 more in rent just because their appliances have stainless steel covers, as an example. The next tab is the unit renovations. As discussed, you will generally be given some guidance from the broker about what improvements can be done in the individual units and how many units can benefit from these improvements. As you can see here, granite countertops, this is a per unit cost estimate, right? And I'll show you how this feeds back into the dashboard, and we can play with that number going forward. However,
Bernard, if I could jump in, each part of the country has varying prices for renovation. So, stainless steel appliances, and also depends how many you're getting. Are you getting just a fridge and a stove, or you're getting a microwave and a dishwasher? Because that could run up to $1,800 as well. And flooring, it all depends on the size of your apartments as well. So there's a lot of different factors, but it's a really good overview.
Yeah, absolutely. That's a great point. Kind of mention it here as well, because you hit the nail on the head. You will, during your due diligence, want to discuss this with an expert who is local, both in terms of home improvements, or if there's a GC you plan to work with. You would, as you mentioned, want someone with local knowledge who knows what the costs would be. Some of these costs, you're right, are not actually per unit costs, or they wouldn't even size it per unit. They would size it per property based on how many new units needed, and then you would have to divide it into it. Absolutely. Moving in, and actually keep that in mind, because the next area, which is common area CapEx, the current property manager would have the most insight on this. Obviously, a GC would have to walk the property, or any kind of contractor you use would have to walk the property and tell you as well what other improvements need to be done, right? Light fixtures in the hallway, windows, doors, carpeting, paint, etc. This is a cost that you need to consider is not necessarily directly improving your rent per unit. However, it has a lot of value that you may not necessarily be able to directly underwrite, but an improved property, right, with an improved landscaping and better doors and better security systems is likely to attract better tenants, or tenants that are willing to pay more for apartments. So it does translate partially, but just consider it's not a per unit calculation always. Again, the best person to opine on this is probably the property manager, the one who's been dealing with the property the longest, and they hear the most from the tenants in terms of what they would like, what amenities they're focused on, what amenities are not being used, so maybe you can postpone those developments, etc. Of course, here it's broken out into 3 items. You can always break out into more items as necessary if you have a more detailed layout from a contractor or property manager. And the reason it is done by year, as mentioned, is you may not want to do everything up front, which means you're not really capitalizing equity or debt proceeds up front to pay for these improvements. You can potentially say, look, by year 2, I expect my NOI to be a little higher. I'm just going to use cash flow proceeds to pay for the year 3 improvements for door repairs of $15,000, which obviously helps with a lot of your return metrics, your cash on cash, as well as your IRR, given that you don't have to take that money today to pay for something 3 years from now.
Renat, when Kyle and I walk a property, we use pretty much like a 100-point checklist to go over all of the items that need to be repaired. And it really helps us when we're underwriting to think of all the things that we may not think about. So we make sure we check each box on that. And we always raise money up front for the CapEx because we don't want to be in a position where we're undercapitalized, particularly if you're heading into a recession or something. So we get all that money up front, and most likely we'll have extra money in our savings, but we can use that for a rainy day or bring it, give it back to the investors, but at least we have it up front. So we don't like to use cash flow on those, on the CapEx.
Yeah, that's a great point. It is a great way to provide cushion. Personally, I think that's the right way. If I can be a little biased. A lot of people want to be a little more aggressive with their returns as metrics get tighter. So what they end up doing is they just say, I will only improve doors if I am able to improve the property in other ways first. But I think the way you do it is the ideal way. That is the right way if you can obviously afford the equity up front. Absolutely.
Ray, this is Kyle. We did have a question coming in. Do the timing of these CapEx improvements all become integrated in the annual returns and distributions on other tabs?
Sorry, would you be able to repeat that?
Do these CapEx improvements all become integrated in the annual returns and distributions on the other tabs?
Yeah. I'll just jump to it really quickly right now. But essentially, these CapEx costs translate to your annual pro forma, which we'll have here. These are generally obviously below the line items. Here they are, common area CapEx. Given that obviously what's reserved up front is something you do in the beginning, essentially it's baked elsewhere. But common area CapEx will be passed on forward here. Again, I'll go through the math in a little bit, but essentially you do it this way because, as I mentioned, in case you're not reserving for it up front, you're able to just push it to your cash flows later if you have the cash flow available. But to answer the question, yeah, it feeds directly into the pro forma. Did that answer the question?
Yep, perfect. Thank you.
Yep, of course. And since you mentioned the 100-point checklist, if there's anything you'd like to kind of mention right now that's very common from your experience, definitely let me know. We can definitely discuss it as well. Generally, it is, in my experience, property managers will tell you about the amenities that are and are not being used by tenants. And that is kind of the beginning of, kind of polish up the property as you're becoming very aggressive about a releasing strategy. Thereafter, it's, hallways, because that's the next obvious thing, doors and windows, paint, etc. Anything else that kind of falls by the wayside, obviously utilities become a big one. Anything that's, low usage, toilets, for example, faucets, etc. That benefits you in multiple ways. Obviously, that lowers your operating costs theoretically. It also is obviously more pleasant for the tenants, but that's not, to be frank, the first shiny thing that new tenants will potentially see. So a lot of people, if you can't, ideally, as you mentioned, you want to have all the money up front. You want to, pay for as many things as possible up front to improve the property. If you do have to space it out, this would kind of give you that ability if you are getting aggressive. Moving forward to the next item, transaction costs happen in 3 different phases. Obviously, you have closing costs. You'll have financing costs should really come next. However, financing costs are anything regarding origination fee, acquisition assumption fee, and mortgage broker fee. And then you obviously have selling costs when you actually let go of the property. There's one other cost that's actually not listed here is because it's circular to supplemental financing. If you are, in fact, getting additional proceeds or good news money in year 3 from your lender, they may charge you a fee at that time, but it is circular to when you do and if you do receive those proceeds. So they're not exactly included here. However, in terms of the source of this kind of information, usually you would get this from either an experienced analyst, an experienced broker. A lot of brokers are actually very helpful with this aspect of it, as well as any previous experience you may have or comparable deals that you may have done. The last item that would actually require hard inputs is the detailed pro forma. This is, as I mentioned, you'll get a Yardi form, usually a T12 or a T3, or some kind of year-to-date or a statement. You would be able to input the way I like to do it at least, is you'll have several options. Let's say I got a T12 and I got a year-to-date, and I will input both of them as they are provided to me. As in, you know, a lot of these items are obviously very recognizable. You'll get market rent, all these line items that decrease it to get to the effective rent, plus the other income, any expenses, market leasing, repairs and maintenance, payroll, admin, and then obviously taxes and insurance, the fixed expenses, as well as utilities, the variable expense. Also, obviously, a property management fee that you'll either take yourself or you get a third party. This gives you a historical NOI for perspective. And what ends up happening is, theoretically, you know, a lot of people have varying opinions on this, and I'm actually very open to the conversation. Would love to hear other people's opinions on it. What ends up happening is you usually, depending on how conservative or aggressive you want to underwrite, depending on your experience, depending on what you know you're strong in or what you're weak in, you will underwrite from individual parts for your year one here. You will say, well, look, I know very well that my property management fee, I'm willing to waive it for myself, or I'm willing to lower it, or I'm going to raise it. So you really have to analyze how you relate to the current historical pro forma. Same thing for utilities, because you're assuming that you're going to be either doing some CapEx upfront or you're not. It might be different than what the historicals reflect, or it might be the lower of the two, or it might be the higher of the two. And the same thing obviously goes for payroll. If you have any kind of scalability because you have a great national contract with some kind of management company for repairs and maintenance, landscapers, et cetera, if you have some fixed fee and you happen to get a lower rate, that's great. So you really have to take that into consideration of how you underwrite your year one.
When Kyle and I are looking at a T12, this is where we like to find gold. You know, are they over marketing their property? Are they under marketing their property? Do they have way too many people on payroll, or are they underutilizing payroll? Can we implement a green program and save 15% plus on expenses on utilities? So there's a lot of ways we really hammer in on this T12, and not just look at the totals, but on a month to month and try to find inaccuracies in that.
Exactly. Yeah. Like snow removal, for example, right? If, you know, there's some assumptions there. You're 100% right. Let's assume this wasn't a value add deal. Let's assume this was a core deal. What you're saying is actually true. This is when a core deal becomes a core plus deal, right? Because you look at this and you find ways that you yourself would be able to trim out the fat, and that is your business plan, and that is why you potentially might be the more competitive offer or the less competitive offer, depending on your strategy. And you can obviously be very honest with yourself here and see if there is any fat that you're able to trim. But absolutely, all those line items by month would be great. I have hidden, to your point, I've actually hidden the Yardi tab that feeds these items, obviously, as you can see. But you're right, those tabs will be provided by month. Let's actually see if I can unhide one. Yep, so this is, I'm sure this is familiar for a lot of viewers. You will see by month every specific line item, and you will be able to, you know, pull out what you think may or may not be relevant to you, right? If you have a certain, obviously, as you mentioned on payroll, right? If there's certain issues, if you can save on insurance because you have some kind of benefit program for your whole company, great. This is where it would go into. The last tab, it's just an engine. It pulls from the dashboard. We'll get into it, but essentially it calculates every hurdle at every tier. That is a split between the LP and the GP. So there's really no math that goes into this. Or there's a lot of math, but none that you would have to plug in yourself. So with that, we will go back to the dashboard where we can now start building our business plan now that we have everything plugged in. Starting with the top left, obviously you have your salient information, name and address. Obviously does not affect the pro forma other than the fact that there are 79 units, which feeds from the unit mix. Summary of the rent roll, again, these are all hard codes. As you can see, they're all black. And by the way, let me know if you need me to zoom in because I know it appears differently on my screen as it might on yours. But if you can't see, let me know. I'll definitely zoom in. Here is the big one, the unit renovations, and this is the value add component. This is where you begin to consider, and you would obviously have to visit the property. You'd obviously have to see what is going on and to see how many of the units are currently rented below market and what improvements could potentially even increase the rents above market. You would have to be honest in the sense of obviously the broker provided saying that 100 of the units are available for renovation. We'll go with that assumption. And we're going to assume that we're going to do 4 units per month. You're going to do a calculation and you want to understand, all right, well, I'm going to start in month 4 and I'm going to go to month 48. And you're frankly not going to get to all the units at that point. And that is actually okay because that might be what the previous seller might have done for you as well. What you want to do is you want to leave the property with a little meat on the bone for the next buyer, for them to be able to bring some improvements to the property and have a business plan that allows them to increase the revenue, the operating income even further.
I really like that part in the analyzer. I haven't seen that in others. And I think that's where a lot of beginners go wrong because they assume, hey, we're going to renovate everything and we're going to get market rent right away. And it really takes the bigger the property, it could take 2 years to get the rent to burn off the loss to lease. So that's really important when you're analyzing a deal that it really takes time to renovate all the units and get them all up to market rent.
Yeah, absolutely. If we go back to the unit renovations very quickly, you consider how long it takes. Well, first of all, the unit has to be down, right? Obviously, you can't do some of these, in most cases, you can't do some of these renovations for on a unit when somebody's occupying it, especially if it's a studio. Obviously, depending on the relationship with the tenant, but more likely than not, right, you have to wait for the unit to roll, in essence, for you to be able to renovate it. Then you have to consider how much time it takes to renovate it, and then you have to consider how much time it takes to release it. So absolutely, there's going to be, you don't have necessarily 100 people working, right? Or you can't necessarily afford it, or the contractor you're hiring can't exactly afford it either. So you really have to take into account that there is a limit to how much can possibly be done. And you're also balancing that against your hold period, especially if you have investors that have a specific timeline. But absolutely. And as I mentioned earlier, the big item that will forever be disputed, and this is usually up until the acquisition for a lot of people, is the rent premium that you may expect to get. And the reason for that is there are a lot of factors that go into it that are both qualitative and quantitative. Quantitatively, as we've discussed, obviously you look at where current market rents are for comparable units, where your rents are, what are the difference in packages of amenities, what are the difference in the unit types, paint, appliances, countertops, et cetera. Qualitatively, you have to be very honest with the demographics that exist in the area, especially if you're looking at things like Class C properties. A lot of people who are renting by choice. Some people are renting because they don't necessarily have a choice. And you'll obviously see this a lot in some secondary markets, but definitely tertiary markets, where renters, they don't care how nice that marble is. They're not paying you $120 more per month. So it's something to definitely investigate. It's something to definitely talk to the property manager, as well as any other property management companies that you may have a relationship with, to kind of give you a regional and both a sub-market understanding of what may or may not happen here. Just for context, I put in $120 a unit. I obviously have been generally conservative. As you can see here, this is provided by the OM. the argument was for $225 per unit. I generally don't think that is possible. This is my personal opinion. Some people are hitting that business plan today, some people are not. What you're generally, the conversation, the way it really rolls up is your return on cost. I know some people today are looking for 40%. I know some people today are looking for just under 20 in the high teens. So this ranges greatly. It ranges a lot depending on your cost of capital and a lot of other factors. But I would love to hear your opinion as well, guys, if you have any opinions on this item. But I know this is probably the biggest, this is the meat of the model essentially in terms of engineering the business plan. Moving down, yeah, go ahead.
What did you want to hear my opinion on?
No, if you know, and we can say this for the Q&A, of course, but I'm assuming this is a commonly discussed topic in terms of what value add, what kind of value add, how high your return on cost can be on a value add project. Some people are very aggressive in underwriting this. Some people are becoming more conservative. And I just wanted to point out that a lot of factors feed into it. So it's definitely a topic of debate always.
Yeah, like you had mentioned previously, like we always work with our property management team because we need to be on the same plan when we're implementing a business, as far as where the rents were going to be, the rehabs to be done, and not to be, you know, too aggressive, and you know, and we test things out. So it's really working hand in hand, and having those weekly calls once you take over the property is so important.
Yeah, absolutely. And actually, you kind of reminded me of an excellent point of if you are bidding this out to new property management, let's say new third parties, there's a little give and take and a double-edged sword of that discussion. On one hand, they obviously, as part of their business, want to deliver the best results for you, and they want to portray that they are able to achieve those. On the other hand, you want to be realistic, and they certainly want to be realistic because they are going to be held, obviously, to a certain performance standard based on the discussion. So it is, you know, it's as you mentioned, it's a lot of back and forth. The next item is market and pro forma assumptions. The way I like to do it is I like to build it out for more than just, you know, 1 year and then trend that same number. As I mentioned earlier, anecdotally, you know, Amazon in Arlington, Virginia. You think about the Pittsburgh Arts Center. These are things that, you know, potentially nobody could have predicted in the area. Some people might have because they looked ahead for who's signing leases, who's moving where, you know, the young college graduates are moving, et cetera. Nobody would have known that Pittsburgh would have become a startup hub, for example, right? And with the startup hub came the Arts Center because that became cool for startups. And with that came really great dining locations, et cetera. Right. So, and with that, obviously, from a multifamily point of view, rent started growing fast. And I think I could be wrong on this. Pittsburgh is actually one of the fastest rent growing markets. And it could have capped out by now, because obviously by the time you know about it, it's too late. But a lot of people who were keen on investigating demographic and commercial rents or commercial leases that are going on in the area may have foreseen that and done a secondary kind of point of view and understood that perhaps multifamily, it's a time to invest in multifamily a couple of years ago. So all that is a long-winded way of saying that perhaps you're going to say market rent growth is 4% in year one, but perhaps because you know something the rest of us don't, you're going to know that a certain big employer is going to move into the area and year 4 is going to see a really big pop. Something like that. And that's why I build a matrix for more than just the first year. People might have different opinions on that. In terms of identifying what you can trend at what rate, I know a big one, obviously concessions, bad debt, gain loss to lease is a really big one. Frankly, from my experience at least, and I would love to hear everybody else's point of view, the lender will drive a lot of this because the lender in the conversation will have a lot of the experience in underwriting what actually got done as far as deals. So they will almost maybe put pressure on you to underwrite a certain amount. Maybe it's a back and forth negotiation and you'll be able to justify it with certain comps and performances. Generally, the industry standard has been 3% for revenue items, 2.5% for expense items. Given various aspects happening in the market, you're seeing 3 and 3 instead of just 3 and 2.5.
And that's heavily weighted on which market you're
Yes, that's
working
it. Yep.
in. And CoStar
Yeah.
is an excellent place to get report on rent growth as well.
Yep. Exactly. Yeah. A lot of those market reports, CoStar obviously being one of the better ones. Green Street certainly has a lot of good data if you have access to it as well. Absolutely. That's not a plug. We don't have subscriptions though. Yes. And the last item here is the property management fee. Again, this depends. A lot of people have their own property management firm. I'm sure a lot of people on this call do that. Sometimes you will outsource to a third party, and that's part of the conversation, what kind of leases you're expecting to get. This is entirely deal specific, so I put 4%, but it can be very different for your transaction.
And typically for people, so if you're looking at 60 units or above, it'll be closer to 3%. When you're getting into those smaller units, then it's going to start creeping up 4, 5, 6, depending on. And additionally, though, you'll still have to pay payroll on top of that.
Exactly. Yep. Yep. And yeah, whether that's yeah, exactly. If that's third party people or your own people, absolutely, that's separate. Right. Yeah. Property management fee is obviously tied to your revenue, so that makes sense. Property tax resets. Again, depending on the state you're doing this is becoming a very contentious issue, and this is where regulatory, quantitatively, regulatory changes play a big role. So just for context, we're not there yet, but I'm underwriting the purchase price at $12.25 million, which is about $155,000 per unit, which for a secondary market I think is actually a little below average, but it's about there. But just for context, we're going from $12.5 million or $12.25 million to $17 million within 2 years. A lot of this is based on performance. Some of it is based on what the local municipality, I guess, is able to hike the increase or the reappraisals by. There is a delay in underwriting, which is why we're delaying 2 years after acquisition for a reappraisal. Something to be considerate of, it becomes a big deal on new constructions, obviously, because you're paying a tax on the land and then you're paying a tax on the initial property. And then you may or may not, experience a big jump in a reappraisal thereafter, which will be a delay, which is why you see actually, not necessarily related here, but for construction properties, a lot of people are trying to get out of those deals earlier and pass them on to the core and core plus investors, just as an FYI. But again, a lot of this is, it'll take some research to understand the municipality. But it is, frankly, at the end of the day, a pro forma guess, hopefully educated. Moving up to the source and uses, this is front and center, but I'll actually come back to this last, and I'll explain why. Usually, once you have everything else in your business plan discussed, everything that we have discussed so far, as well as the remainder of the financial gearing, this is where you start to see how aggressive can you be to be competitive and successful in winning the transaction. And it's not a coincidence that this box that I keep side by side with my IRR and my cash on cash, because at this point I say, okay, I'm comfortable with everything else on the road. I can live with those assumptions. I believe I can hit this financing and that renovation and this pro forma. What can I buy this at? The most aggressive price I can possibly offer to still hit my returns that I expect to provide. Some of the bigger ones are obviously IRR and multiple. For a lot of investors, not everyone, but a lot of them, it's the first 5 years of cash on cash. There's at least a minimum threshold they have. So it may not be the case necessarily, depending on how aggressive of a value add this is. You may see a year one of, let's say, 4, as long as the rest of them are over 7 or over 8. Some people will take that, but it varies greatly. We'll come back to playing with this at the end, but I just wanted to point it out right now. So the big engineering in financing, in multifamily generally, is financing. There are 2 boxes here. There is the acquisition financing, And then there's the supplemental financing, which sometimes is called good news money. Essentially what ends up happening is you obviously have an acquisition loan, which here is set to 8.8 million approximately at a 72% LTV. And just as a side note, I hard code, there's a choice. You can either hard code the LTV and it'll calculate the proceeds, or you can hard code the proceeds and it'll calculate the LTV. The reason I do it this way is because the model is more flexible when you're already discussing with the lender, because at a certain point, you know you're going to be, let's say, in the high 70s or the mid 70s. And at that point, you're just triangulating to a number, so it's easier to just have a number to plug in that the lender's throwing to you in a term sheet. The big, I think, biggest conversation we'll have tonight is on the spread over a 10-year treasury. And it's more importantly than the spread is the actual treasury. We all know what's going on in the economy, and it is a global aspect, it's a global thing that's happening in the world. I actually spoke to one of my friends from Chile. They are at their treasuries at, I think, 25 bips. As you know, a lot of the European countries are hitting negative. And we are, in essence, being pushed by that lower in our treasury. The G7 is currently going on, so everything I say right now could be completely moot within 48 hours. So it is probably the most volatility you'll see in your underwriting is in these two numbers right here, the 10-year treasury and the spread. Anybody who tells you they know where this will be in a year is frankly not telling the truth. So it is something to consider in the underwriting and the lender you're speaking to, at what point you can lock and at one point, and obviously that has to align with your acquisition due diligence timeline. I'm sure a lot of people, I'm very happy to have a discussion. I would love to hear everyone else's opinion on this because information changes. It's not just daily at this point, it's hourly in terms of what the expectation would be. But from an underwriting perspective, from the mathematical perspective, you obviously have an option for whether this is fixed or float. I just say, 10-year treasury and a fixed spread, or fix a 10-year treasury with a fixed spread on top of that, which gets you right now to a 4.54 rate for your loan. For underwriting purposes.
Renat, on the financing, I think this is just such a big piece when you're underwriting a deal. How do you stay conservative when literally right now, every day, the rates are moving up or down?
Yeah.
Do you have a rule of thumb that you abide by to make sure that you're not being retraded from your lender or having to go back and rework your numbers after your offering is live?
Yeah, great question. It's not even a matter of being retraded from your lender, frankly. It's a matter of everybody else that's working on the transaction. And what I find, at least, is everyone has a different perspective, A, and B, everyone has a different, frankly, risk profile and incentive to be more aggressive or be more conservative. I am currently showing 300 to 350 bips on every deal, regardless where Treasury shakes out, and that way we can always go down from there, I think. Generally, the last few loans I've seen have been in the 4.5 to 400. That being said, depending on what happens this week or next week, that could easily be 5 to 5.5. There's unfortunately, to my knowledge, no way to be any more conservative than that. I think the lenders don't necessarily know more than you do, so it's something to consider. It would, from a perspective of being the sponsor or the acquisition party, you're incentivized to frankly lock as quickly as possible while the rates are still low. That's about the extent that we've had experience with so far.
One thing that Colin and I are seeing also is, we're not even in the fourth quarter yet, but Fannie Mae is really tightening their lending because they basically hit their quota for the year.
Yep.
So you're seeing higher interest rates, lower interest only, no waivers. Yep. So it really, really affects the deal. Just a slight change. So like you say, you have to be conservative when you're underwriting.
Yep. Yeah, what a lot of lenders find, this is actually throughout the risk spectrum, both from all the way from core to all the way to new development. What they end up doing is because they, as you said, they don't know where the their own, the treasury will be, so they don't know where their spread should be. They become conservative on the LTV itself. I think 2 years ago, you would have likely have seen just the general 75 to 80% LTV. This is why I stay closer to 70, low 70s. And as you can see, even on the supplemental, we'll get into that in a second, I say probably mid to high 60s is how they're going to look at it. Just because down the line, they're just, the one thing they know, right, that they can guarantee lowering their risk on is the LTV. They don't know that if they give you a 200 spread or a 300 spread, where treasury are going to be, and suddenly they're either completely not competitive or they are just, you know, they're kind of screwed themselves, frankly. So they would take conservation on in terms of the amount of proceeds they put out, which is the LTV essentially. The other aspect is, you're right, used to be, I think generally was 5 years. Today you're going to see anywhere between 2 and 3 on the interest only. Amortization usually is 25 to 30 years. I put 30, but you can obviously be conservative and put 25 as well. With that in mind, so that is obviously financing at acquisition. What is next, and sometimes called good news money, it might be the same lender, it might be a different lender that you refinance to. For the purpose of how this is built, it allows for, frankly, that to be a moot point. You're basically getting additional proceeds on top of whatever loan you currently have. So whether that is a new lender refinancing your whole loan and giving you a new big one, or your current lender giving you additional money, it's irrelevant for the purpose of underwriting. Here, I usually like to keep a toggle in case it is not part of the plan at all, right? We'll just turn it off and it doesn't calculate. I'm going to say we're using it, obviously. And I'm going to say we're doing it in year 5. Actually, I'll just lower that to 4 for now. In year 4, how are they going to size your property? I put a 5% cap rate, obviously a little bit aggressive. And again, right, the big question is what rate you're going to get. This is a blended rate. The assumption is you're getting this at a 4.5 approximately, the initial financing, and that the additional proceeds, which only come out to about $3 million, are going to probably, I think, shake out to, given this math, approximately like 6.5, which is also conservative given that it's a few years from now, 6.5, 7. So it blends to about 5 total for your blended return, for your blended interest rate. The 3 ways they will size this, by the way, also the same IO and the same amortization schedule toggles. But the 3 ways a lender will size this are the debt service coverage. Basically, they're saying that you need to make $1.25 for every dollar that you'll have to pay in debt. Debt yield for themselves, usually about 8. I think it's anywhere between 8 and 10, depending on the asset class you have. Multifamily generally has the lowest debt yield required because it is technically the safest property type. And max LTV, as I mentioned previously, lower than your initial financing for the purpose of the lender staying conservative. The calculation of how this comes out to you, you have your loan, which is basically the minimum of the 3 tests, so 11.7 million approximately. The 1%, which the bank takes as a fee for financing or refinancing, and then your repayment of the initial loan that you still have on the property in year 4. Obviously, it gets amortized a little bit from 8.8 million to about 8.7, which means that using arithmetic, your net supplemental proceeds are 3.1 million. Essentially, you can think of this as a cash out. The last major point of discussion is the disposition exit cap rate. So we're holding this property. This is obviously a toggle for 6 years. I should have just did it at 6. So we'll just say it's a 6-year hold, and we're planning to exit at a 6.5 cap rate. Just for context, we are going in at $12.25 million. The going in cap rate is around 4.7%. Again, just like interest rates, this is an item that you cannot really predict. The general rule of thumb for most underwriters, for most brokers is 12 to 15 bips per year addition. I put frankly, a very conservative exit of 6.5, given that we are doing a renovation on a lot of the units, and there is going to be a little bit meat on the left on the bone, but you can't really guarantee where the market will be 6 years from now. With that, you are obviously still making out positive on what you purchased it for and what you spent on it. Just as a side note, while we're going back up, the JV structure is your structure with your LP or your GP. I set it to only, at this point, it's allowing you for more than 5 hurdles essentially. I set it to a hurdle of 8% preferred return to the LP. Thereafter, you're splitting every dollar 70 cents to the LP, 30 cents to the GP. If you have more hurdles, right, you can just basically set these up. If you have more hurdles, you can obviously, set up different tiers in the waterfall. From my experience, this obviously varies greatly as well, depending on your relationship. The preferred rate today is, depending on how core it is. On the core end, it's probably maybe 6 or 7. Value add generally is an 8% hurdle. That's this box right here. And on construction, it's probably closer to 10 or around there. The subsequent hurdles vary greatly. Had multiple discussions, and frankly, it's such a great range that it's not even worth quoting. I'm happy to quote it, but it might be almost irrelevant for everybody on the call. So with that being said, we scroll up again to the last item, which again is the purchase price. And here, while discussing the purchase price, we obviously review what the returns are. As you can see, by the way, cash on cash year 5 and 6, the reason they're so high is here you get your cash out from the supplemental proceeds. Here you get your sale from the sale of the property. Otherwise, generally, you're expecting around a 6, which I think we're at a 5.8. So all that's left to do now is essentially try to back into the return that you are comfortable living with and you're confident you can essentially hit. And this is where you try to get more aggressive or less aggressive, depending on what your targets are. I know people that are targeting value add properties today at 12%. In fact, if you look at funds like Blackstone and Brookfield, they're probably around there. Obviously, they have different economies of scale. I know some investors who are trying to target 18, which frankly are becoming very tight and aggressive. With that, the model concludes. I would love to open up for discussion if anybody has any questions on any of these engineering items.
Perfect. Thanks, Renat. We do have a couple questions. What is an assumption fee? I'm just going to read them off to you if you can go ahead and answer them. And then anyone else who has questions in the meantime, please type them in the Q&A box.
So an assumption fee here is calculated on a loan being assumed. It is, in essence, as we discussed, the financing, right? So we assume that the financing of proceeds are $8.8 million. In this specific case, and I want to kind of go into that toggle, but it seems frankly kind of trivial, but if there's a loan on the property that you can't prepay, you're just going to assume it. In some cases, there is a defeasance. In some cases, you can just pay the assumption fee and take it over for the lender. It would be the equivalent of, or the transaction, it'd be the equivalent, if you don't have an assumption fee, you'll have an origination fee for a new loan. That's the only difference.
Okay. We had a lot of people asking if they could see this model, and I know we're not sharing this model with everyone, but where can people find a model similar to it or other models for underwriting online?
That's a great question. I just want to caveat that these are not plugs, but Adventures in CRE generally has a lot of sample models. I believe that's the website, adventuresincre.com. If you guys know exactly what it is, but I'm sure if you Google Adventures in CRE, which stands for commercial real estate, it'll give you that link. There are a lot of free content on there. Some brokerages may offer, and these are more regional brokerages, may offer underwriting models. They are going to be a lot more simplistic. This is obviously complex for the purpose of sparking a discussion and showing the various toggles. A lot of them you'll find will provide you kind of like a one-pager. It's almost like a triage of a deal just to show you high level, does the deal even work or not, so you don't have to waste your time if it doesn't. Otherwise, I'm happy to share with the users if I find any other sources, but off the top of my head, Adventures in Commercial Real Estate is a big one with decent models, and I'm sure if you Google a couple of other blogs, we'll have them, but regional brokerages usually have them as well.
That's perfect. And another question, did you add some contingency or additional working capital into your forecast for additional cushion?
Yes, the way this works specifically, and by the way, just for clarity where this comes from, this was an actual deal. We obviously renamed it and we sanitized the any kind of addresses. But this was a working deal, and we actually added those costs both into the renovation scope and to the common area CapEx. What you could do in addition to that is in closing costs, any kind of contingency for closing. That would be the only other way to do it. But essentially that is a day one expense, so you can't really spread that out. The best way to do it, ideally, would be to have an additional contingency here, right? And just assume that, for example. And I actually didn't mention it, it's a good point. I like to do it this way. You know, some people can do it manually, and it's actually, you know, depending on how much coding you want to do, it's quicker. Any kind of CapEx that feeds from the common area CapEx, I write it as actually you guys mentioned earlier, equity contribution. So it gets contributed day one from equity, or it gets capitalized or reserved. If you want to pull it out of cash flow, as I mentioned previously, as you can see, it jumps here. You can say that, look, I can't pay for future costs I can't raise enough equity to pay for future costs today. I'll pay for it later. So you can just toggle it to cash flow, meaning that those expenses will come out here.
Okay, next question is, how would you model increases in other income like RUBS income, which may take several years to incrementally implement? And maybe you can go into how conservative you are when you're implementing a RUBS program into a property that does not currently have RUBS.
That is a good question. So I usually bake it into concessions and gain and loss. Alternatively, sorry, RUBS, it would be, one moment. You would potentially have a line item here, and you'd be able to, in addition to that, obviously add a specific item. As I mentioned, I bake it into something, but you would say potentially, all right, let's say instead of, this might break it, so bear with me, right? So let's say you have RUBS, hypothetically, and you would add a row here, and you would trend it either positively or negatively. And you can set 0, 0, and as you mentioned, it might be a delay, and set it to start in year 3.
Yeah, I'll just add to that is, you know, every market's going to be different and every sub-market's going to be different. And the first thing you need to look at if you're going to implement a RUBS program is your competition doing it, right? Because if most of the properties in that sub-market are not adding RUBS and you're adding RUBS, you're going to have a much more difficult time implementing it. But what we do is we take a look at the lease expirations for year 1 and understand that if the property doesn't have RUBS currently, then you cannot add RUBS on there until the lease expires. And so we'll take a look at that, number 1, to project what the blend will be throughout the year, but we'll also take probably about 80% or 90% of that number and implement it for year 1 projections. So we won't take all that up front.
Yeah, that's a great point, actually. That's a great way to do it.
The next one is, I thought the exit cap rate is lower than the going in cap rate. I can answer this, or Ray, you can answer it, up to you.
Feel free. I'm sure we'll have the same answer.
Yeah.
The
So
assumption is that, yeah, go ahead. Sorry.
you definitely do not want to see an offering where the exit cap rate is lower than the going in cap rate. That would mean that they're predicting that the market's going to be stronger than it currently is, which is an aggressive assumption. Typically, you want to see more conservative assumptions where the exit cap is greater than the going in cap. And I would even go a little bit further, and you want to know what the actual market cap of that submarket is for the size property and the class property that you're buying is. So, for example, if you're buying 100 plus units in a C class, for a C class property, you want to know what the market cap of that property is. When you're buying value add properties, you may buy a lower cap rate than the market because you can add value and get it to, a higher valuation. But so really, I don't pay as much attention to the going in cap rate than what the market cap rate is. And I think what Renat mentioned earlier is you typically want to see 12 to 15 basis points higher per year of hold. So if you hold it for 5 years, you're going to want to see 75 basis points higher than the market cap rate. So if you're buying at a 5 cap, 5 years later, that'd be a 5.75 cap.
Yep. And not to muddy it, but just to illustrate it, how it works is you're buying at a very aggressive 4.7 approximately, right? That's the going in cap rate we saw. And every year, theoretically, as you see your NOI increase, right, from improvements to the property, from releasing at a higher rent because of renovations, you'll see that the cap rate on that same acquisition price, if it's still 12 and a quarter million, right, is theoretically increasing, right, because it's higher. It's an inverse calculation, obviously, NOI divided by the purchase price. So by the time you're exiting in year 6, you're at an 8, which is essentially your return on cost, right, or return on acquisition cost. And if you're selling at a 6.5, but the property is really an 8 at a 12.5 million, that's how you know that spread of 1.5% means that you're making more dollars, right, because it is an inverse of a price to earnings. And if that confused you, I apologize. So just leave it at what Kyle said.
No problem. Okay, this question is for me, but I'll read it out to the group so they can hear it. If the underwriting model makes sense at 12.25 million, do you make an initial offer closer to 12 million knowing you have room to move up? I would definitely say that you don't want to go all in on your top price. You need to know that there's going to be some negotiation there, especially nowadays when you're going into a bidding war or call for offers. There's going to be a best and final, so you need to leave some room in there. So I definitely would not go in at your top number, and you never know where that can go from there, but you want to leave some room to negotiate. And then secondly, they say, let's say they're asking 15 million on this deal and your underwriting says you shouldn't pay more than 12.25 million. Would you even bother making an offer? So what Gary and I do when that is the case is we'll call the broker and we'll ask them. We'll say, look, this is where we're underwriting at. This is why. And just have a conversation. And sometimes they've said, look, that's way too far. Don't even bother. Or they'll say, hey, throw in an offer and we'll see. Now, if they're asking 15 million and they're doing a call for offers and you're off that much, then it's probably not worth wasting anyone's time. But if this is not a call for offers type of situation, then it doesn't hurt to throw in an offer. But I would preface that with making a phone call to the broker to establish that relationship, because a lot of times if you just throw in a low ball offer without saying anything, you're going to piss someone off. But if you're having a relationship, or if you're trying to build that relationship, if you're open with the broker and he says throw it in there, then, work with the broker and throw it in there.
Yep. Brokers will often call it a whisper price. And it's kind of like the conversations from the ones that I've had, at least, are always like, tell me what I need to bid to be in like the second round of renegotiation term sheets, essentially, right? Especially if it's a marketed deal, right? A lot of people are looking at it. You're essentially asking them, like, tell me what I need to be close to at least be reconsidered so I can take the deal seriously. And as you mentioned, Kyle, if the price is out of anything, out of your realm of, as I've just put in 15 million, and it completely kills the deal for me, at least, right? Like, just put it down, right? Don't waste your time on it. And frankly, don't waste the broker's time as well. It's just not going to work out.
Yeah.
Sometimes they'll give you a very reasonable whisper price and just tell you that, just as long as just hit this threshold, right? Hit the 12.2 million threshold, and then we can discuss it from there.
Okay, regarding your interior renovation calculations, couldn't you just lower your economic vacancy percentages in the first couple of years to account for renovation plan versus calculating it all out?
That is correct. Yes, you can.
Is there any reason why you would do it one way or the other?
No, it is a, it's you know, you're fixing one variable or another, essentially. That's it.
Okay, perfect. Let's see. We have a couple people asking for your contact info, and we can share that at the end, but would you mind maybe just quickly saying what your contact info is for everyone if they want to reach out to you guys?
Absolutely. So you can reach out to, well, Tyler's is easier, and he can forward it to me. My last name is very complicated. It's Tyler, Tyler, at bullpenre.com. Alternatively, you can actually contact us, and this is the more formal way, through our website. It's bullpenre.com. You'll be able to contact sales, and that would be me.
Perfect. And it looks like that is all the questions. Oh, we have one more. Sorry. Is there a quick and dirty way to filter out deals within a minute or two without doing a deep dive to determine if the price is way out of the ballpark?
Yes. The quickest way I would guide you is, and usually, I mean, other than the broker, is the price per unit, essentially. It is one of the more common ways to look at comps. I know that price per unit in, West Philadelphia today are actually hitting some crazy number, or theoretically a crazy number of around, I think it's 170, 180 units. If you're looking at outskirts of Austin, for example, it's probably closer to 100, 110 a unit. So a lot of markets will have these general prices per unit. And if you're looking at something that you don't even want to do a model on, that's probably your quickest way to do it. Alternatively, I have some very generic pro formas that I build, and they just, without any of these individual, toggles, in essence says I pay 12 million. My acquisition costs all in are about 4% or 3%. So my total acquisition cost, let's say, and just at this point, just rounding, let's say it's 13% or 13. And I apologize about the sirens. This is the benefit of living in New York City. So I will say my total uses are about 13.5%. What kind of NOI am I getting? And then I'm just looking at my cash on cash. And is it even within my realm of what I'm expecting in the market today, or what my investors are expecting? So having kind of a better understanding of what you're looking for, which is cash on cash, or what the market price will be, and then you'll know market price per unit.
And I would add, when you're looking at market price per unit, make sure you know A class, B class, or C class.
Exactly. Yes.
Yeah, I would also second what Ray's saying is know what you want, right? So if you're looking for 100 plus units in Class C value add, you can filter out a lot of different deals that are Class A or turnkey or 80 units. So make sure you have your criteria set in advance so you can move the ones that don't match those criteria to the side and have just a pile of the ones that really do fit your criteria. I play golf, so I say aim small, miss small. And so it's the same thing. The tighter your criteria on what you want and what you need, the more focused you'll be. So you're not underwriting things that just don't make sense to you and your investors. All right, I think that is it. And I just want to say thank you to Renat and Bullpen and Tyler Castleberg for joining us tonight. You guys added a ton of value. I know underwriting can definitely be a tricky one, and it takes a lot of, understanding and knowledge to really dig deep on underwriting. So I appreciate you walking us through there. If there are any more questions or you'd like to reach out to us, please, reach out to Limitless Estates, Break a Day, or Bullpen on social media or our websites or our emails that are posted there. The next webinar, just as a reminder, is going to be Monday, September 23rd. Gary and I will be taking you through our 42-unit acquisition that we purchased a couple months ago in Tucson. and we'll go through the highs and lows of everything that's happened so far and where we're currently at. So that'll be a great webinar. We appreciate everyone hopping on, and we will see you soon. We will be sending out a recording of this tomorrow. So thanks, everyone.
Thank you very much,
Thanks,
everyone.